Chapter 9 is all about long-term assets. The document you're looking at here is also posted for you in the Chapter 9 module at our e-learning site. Before we jump into this, I'd like to give you a brief overview of Chapter 9. There are numerous small topics covered in this chapter, but there's three major ones. The first big topic is buying long-term assets. So in this handout, we're going to look at how to develop the acquisition cost. The second major topic is depreciation. How do you depreciate that asset during the lifetime that you're using it? And the third topic is, at the end of the asset's life, what journal entries do we need to make to dispose of the asset, to get rid of it when we're done with it? All right, so the first major topic here, acquisition cost of fixed assets. There's a general rule that I've got underlined here because it's super important. The cost of a fixed asset or long-term asset should include all normal, necessary costs to buy it, get it to you, and prepare it for use. And we're going to use that rule in this example down below. But before we get to that, there are two terms you need to be aware of. A capital expenditure is any sort of cost that will end up being debited to the long-term asset account, and therefore it'll be depreciated over the life of that asset. In real life, you usually just call these costs capital costs. If you capitalize something, that means you're going to debit the long-term asset. A revenue expenditure, and I have to admit I don't really like your author's term here, it really is just any cost that's going to be expensed on the spot rather than being put into the long-term asset account and depreciated over a bunch of years. So if you decide to debit an expense account, you'll be running it through the current year's income statement and therefore matching it with revenues of the current year. And I think that's why your authors call it a revenue expenditure. It's really an expense being matched with this year's related revenues. So this type of a cost usually only benefits the current year, not the entire life of the asset. Or it's something that's going to have to be redone regularly, like routine maintenance. You do it over and over and over the course of the asset's life. Also, costs that are not considered normal or necessary should be expensed right away, such as accidentally breaking a part on a machine. So something that shouldn't have happened or could have been avoided, those things will not be capitalized. They'll be expensed right when they happen. Let's look at the example that we've got down here. For each of these types of costs, we're going to decide whether we should debit the equipment account or should we just expense it away immediately. The first one is pretty straightforward, the purchase price of the equipment. Let's debit the equipment account for $90,000. It's going to be debited to equipment. How about the transportation to get it to us? Should we debit a transportation expense account, something like that? Well, how about we go back up to our rule? What did it say again? The cost of the asset should include all normal, necessary costs to buy it, get it to you, and prepare it for use. All right, so I think the transportation to get it to us is something that should be debited right to the equipment account. Not an expense, but it'll go into the equipment account. And similarly, if we decide we want to have this expensive piece of equipment insured while it's in transit, that will also be debited to, guess what? Yeah, the equipment account. All right, now this next one, this is a tough one here. Let's say that when this equipment arrives, we need to have some of our own employees helping to set up this piece of equipment. Got to get it in the door, bolt it down on a new foundation we've built for it, whatever. And it might take several hours or a couple days even to do that. Usually salaries would go into a salaries expense account. But the time that these employees spent working on the equipment is a little different. Scroll back up to our rule here. The cost of that asset should include normal necessary costs to buy it, get it to you, and prepare it for use. That means that you need to figure out how much of your workers' time was spent doing their regular job, which will flow into salaries expense, and how much time they spent working on setting up this machine, because that time will be debited to the equipment account. It will be capitalized. What do you think about test runs? Maybe we need to put some material through this equipment to see whether it's all going to gunk up or whether it's going to churn out good product for us. Isn't this also part of preparing it for use? Yeah. So the $3,000 will be capitalized. All right, how about this one? Cost to replace a broken part by our employees during setup. Well, let's say that this is a little valve that broke off and went rolling across the floor. Well, we can't operate the equipment without this valve, so we got to pay $100 to fix it. Sounds like if we can't use the equipment without it, maybe we should capitalize it? Are you thinking something else here? Look back up to this paragraph here under revenue expenditures. Costs that are not considered normal and necessary should be expensed, such as accidentally breaking a part on a machine. This looks like something that should have been avoided. It didn't have to happen. You don't have to break the machine every time you buy one. So this will not be capitalized. This will be expensed. And I'm thinking maybe something like a debit to repair expense. So let's debit that for $100. And then either cash can be credited or accounts payable, whatever. There we go. Okay. The idea here, though, is that we definitely do not want to capitalize this. It was a cost that shouldn't have happened, so it will be expensed immediately, flow through the repair expense account. Now this one is kind of silly, but let's say that we are so excited about having this new machine, we decide to throw a celebration party. Whee! So this might be the very best thing we could ever do for employee morale, but is it a normal, necessary cost involved in buying this piece of equipment? I think your outside CPAs might argue that you didn't really have to have that party in order to buy the equipment. So we will not capitalize that, will we? Maybe we could put that into an entertainment expense account, maybe? A couple $1,000. Nice party. And just for simplicity here, I'll again credit cash. But it could have been accounts payable too. Okay. Oops, back that up a little bit here. All right. This is another tough one here. First quart of oil in the new machine, $50. The machine can't run without oil. The metal parts would be grinding against each other. So you have to have oil in there to run the machine. Well, that makes it sound like maybe we should capitalize it. But let's say that you need to replace the oil every 6 months. Now that changes it here. Because now we're talking about something that's not going to last the whole life of the equipment. It's not a one-shot thing, do it once, you're done forever. No, we're going to have to be changing the oil over and over and over through the life of this equipment. And therefore, let's not capitalize it, let's expense it. Either a repair expense or maintenance expense account. Let's try that for $50. So now if we add up everything that we've got capitalized, did that again. Okay, if we add up everything we've got capitalized, we'll see what the total debit is to our equipment account, and I think that comes to $95,000. That means that $95,000 is the total amount in the equipment account which will now be depreciated over the life of that equipment. Notice too that all the costs that we have capitalized are all things that generally happen before the equipment is placed into use. They're one-time things, not going to have to repeat them over and over, and we know what those costs are before you actually start using the equipment. One other thing I wanted to show you, what's the only long-term asset that we do not depreciate? Do you remember which one that is? It's land, isn't it? Yeah, so if I scroll down here, oops, thought I had it on the sheet, I don't. Land is the only long-term asset account that we do not depreciate. And the reason why you do not depreciate the land account is because how long is it going to live there? How many years would you depreciate it over? 10 billion years, maybe more, maybe less, who knows? Since you cannot determine the ending life of this asset, That's the only reason why you don't depreciate it. Now there's one other account that you'll want to read about in this chapter. It's similar to land, but it's called land improvements. This is an actual general ledger account, and the land improvements account will include things that are done on the land, but they're not really buildings or equipment, so they're things like sidewalks, fences, outdoor lights, parking lots. Now we don't just put those into the land account itself, because we just said that land lasts forever and it's not depreciated. But land improvements like a parking lot or a sidewalk or a fence, those things do have a limited life, so they will be depreciated over their estimated lifetime. So you can read about land improvements in the first learning objective of Chapter 9. So that kind of sums it up here, the main points for acquiring long-term assets.